think the Bloomberg consensus last time I looked was closer to 1.1%. So that is powered, primarily by the consumer. So we're still pretty upbeat at Payden about the health of the consumer, the strength of the labor market. The growth in consumer income has been really, really key. I think that's why a lot of forecasters maybe were too bearish in the last 12 to 18 months. They just not seeing that the consumer income growth was continuing. So pretty upbeat on the growth prospects for the U.S. economy, at least.
What I love when we were just talking about inflation, though, is that you sound like you're trying to work it out just like we are. And I think that like says a lot about how hard it is to probably be an economist right now, because some things just don't make consistent sense. So how do you then model out, if you take into the growth that Paul was talking about and the inflation confusion, when the Fed cuts and what that cutting cycle looks like? And if it's a normalization versus, oh gosh, growth is terrible, it's a recession, we have to cut now.
Yeah, it's not that difficult. I mean, we look at what the market is pricing, and if you go back a few weeks, months, the market we thought had too many rate cuts priced in. Why did we think that? Well, because we thought growth would come in better than the market had anticipated. We thought you could have some lumpy inflation as we've seen this morning. So we had fewer rate cuts penciled in. And what we found over the years is, this happens from time to time, but the bond market just gets ahead of itself, where it has too many cuts priced in. And then we can take advantage of that in portfolios by positioning a little bit more conservatively. So we weren't adding to duration and expecting that rates were going to rally here. So that's kind of how we process this information.
Jeffrey, how do you feel about the labor market here? That's been one strong part of this economy from the get-go here. Is it still as strong as it seems?
Yeah, in fact, it looks like it's picked up in the last 3 months. If you look at the 3-month moving average of non-farm payroll growth, it was, as of January, 289,000. I mean, that's excellent, Paul. I mean, like the way to think about that for me is just we need about 105,000 jobs every month to keep the unemployment rate at where it is. So if you're growing at 289,000, that's a pretty good labor market. That's a pretty strong labor market. So things look solid. We're looking at real time, looking for signs of layoffs. I mean, we're seeing it anecdotally, talking to clients in tech. We're seeing it there, but we're not seeing broad-based layoffs, at least not yet. So the labor market looks solid in my view.
Solid labor market, growth's okay. Inflation a little lumpy.
It's sticky.
Yep. Sticky, but it's all right. Is the Fed fueling this? Like, is the Fed cutting cycle that we're anticipating and the looser financial conditions that have already happened, is that fueling any of this?
Well, I think the Fed has been pretty clear. Like, hey, we think if things progress, if we continue to see broad-based inflation, on target month-to-month inflation, later this year, we could reduce our policy rate. That's what they're saying. The bond market is the problem. It gets ahead of itself, saying, oh, yeah, I mean, they're going to be cutting 6 or 7 times. That was probably the easing of financial conditions. I don't really blame the Fed for that. When I listen to Chair Powell, when I listen to Christopher Waller, I think I've heard a really measured story, which is, hey, this is not a slam dunk. We're not declaring victory. We'll see how things progress over the next few months.